Alright friends, let's talk about something every investor needs to know. Taxes. Yes, even when your stock or mutual funds are making you money, the government wants a piece of the pie. But don't worry, I'm here to break it down for you nice and easy. We are going to cover capital gains and how to use tax harvesting to keep more of your hard-earned cash. Given we are in March, watch till the end to understand how we can save 1.25 lakhs of capital gains. So let's get started. First up, what are capital gains? Simply put, it's the profit you make when you sell an asset, like a stock or mutual fund, for more than what you paid for it. It's the growth of your investment. Think of it like this. You buy 100 shares of XYZ Limited for 100 rupees each. A year later, the price jumps to 150 rupees. You sell and boom, you make a profit. Let's do the math. 150 minus 100 into 100 shares is 5,000 profit. That 5,000 is your capital gains. But here's the kicker. The government wants a cut. And how much they take depends on how long you held the asset. Before we dive deeper, let's classify our investments. We are talking about two main categories. Equity, which includes individual shares, and equity mutual funds, basically a basket of shares. And two, debt, which includes debt mutual funds, liquid funds, bonds, debentures, so on and so forth. Now let's talk about short-term capital gains and long-term capital gains taxes. With all the changes in tax laws, here's the deal. If you hold an equity asset for 1 year or less, it's considered as short-term capital gains and you will be taxed at 20%. But if you hold it for more than a year, it's long-term capital gains and taxed at 12.5%. And remember, these rates for mutual funds apply only if they are equity oriented, meaning at least 65% of the underlying assets are invested in equity. Here's a fun fact. India didn't have long-term capital gains tax on mutual funds until 2018. It was only short-term capital gain. But you know, taxes are on the rise and are expected to continue to rise in the future just to fund all government schemes. Anyway, that's a story for another day. Now, for debt, bonds and debentures, the short-term capital gain timeframe depends on whether they are listed or unlisted. For unlisted assets, right now, technically there's no long-term or short-term split. All gains are taxed at your income tax slab rates. This includes debt mutual funds, meaning those with 65% or more debt in their holdings. So let's see this with an example. You buy 100 units of an equity mutual fund for 100 rupees and sell them for 150 within 6 months. Your profit is 5,000, which is 150 minus 100 into 100 units of mutual funds. At 20% short-term capital gains tax rate, your tax is 1,000, which is 5,000 into 20%. So you actually keep 4,000, which is 5,000 minus the tax of 1,000. Yes, short-term trading now has higher 20% tax rate. That means you pay more if you sell quickly, and this applies to any gain within 12 months, no matter how small. On the other hand, if you hold your equity mutual funds for over 12 months, it's long-term capital gains. The tax rate is 12.5%, but only if your total gains exceed 1.25 lakhs in a financial year. And here's the golden nugget. If your long-term gains are under 1.25 lakhs, you pay zero taxes. Let's say you sell after 18 months and make total of 1.5 lakhs profit. Total long-term capital gains is 1.5 lakhs, exemption is 1.25 lakhs, taxable long-term capital gain is only 25,000. And your tax 12.5% on 25,000, which is 3,125. In other words, you only pay tax on 25,000, which is 3,125. Now that tax on capital gains is clear, now what happens to capital losses? Market isn't always about sunshine and rainbows. You will have losses too. Imagine this. You make a short-term profit of about 50,000 and a loss of 45,000. You can actually set off your short-term capital loss against the short-term capital gains. So you only pay on the difference. That is 5,000 in this case. And if you have losses but no gains in a year, you can actually carry forward those losses to next year and set it off again. Just make sure to show these losses in your income tax filings, and more importantly, file a return on time. If not, you will actually lose these losses forever. But here's the vital point. For long-term capital loss, you can only set it off against long-term capital gains in the same year. If no matching gain, you can actually carry forward up to 8 years. You can't set off long-term capital loss against short-term capital gains. However, you can set off carry forward short-term capital loss against long-term capital gains. Why? Because short-term capital gains tax are higher than long-term capital gains tax. Now, let's talk tax harvesting. Tax harvesting is using your losses to lower your tax bill. If you have investments that lost money, sell them at a loss. This loss reduces your taxable gains from profitable investments. Here's an example. You have 50,000 in short-term capital gains and 20,000 in short-term capital loss. Sell the loss-making asset, your taxable gains become 30,000, which is 50,000 minus 20,000. You pay tax on 30,000, not on 50,000. Another way to harvest taxes is if you have long-term gains within the 1.25 lakh exemption limit, sell the stock or mutual fund. This way you realized 1.25 lakh gains, and if stock is good, buy it back again the next day and do it again next year. That way you save taxes on the long-term gains up to 1.25 lakhs every year. In conclusion, understanding these taxes help you make smarter choices and keep more profits. Here's a quick recap. Short-term capital gains, that is gains within 12 months, will be taxed at 20%. Long-term capital gains will be taxed at 12.5% only on gains above 1.25 lakhs. Capital losses set off against gains and you can carry it forward for 8 years. And 4, tax harvesting. Use losses to minimize taxes. Always consult a tax advisor for personalized advice. That's it from me. I'm Nikhil Varghese. Share this video and subscribe to learn how to make your finances less tricky with FinNiki.